So today we would be discussing some of the important terminologies in accounting. So the first word we hear most of the time in accounting is an asset. So what is an asset? Assets are collective resources owned by a company which have future economic value that can be measured and expressed in terms of a monetary value. So some of the examples of assets like a building, furniture, machinery, goodwill, etc. So building, furniture and machinery, while they are tangible assets, on the other hand, goodwill is an intangible asset which cannot be touched or feel, but it has an economic value. Let us understand what are the various types of assets. The first type is a fixed asset, which have generally long-term life and cannot be easily liquidated. These assets are liquidated generally over a period of 1 year time, and that's why they are long-term assets. Some of the examples are machinery, building, etc. What are current assets? Having a shorter shelf life and can be easily liquidated. Or in other words, these are the assets which can be liquidated in less than 1 year time. The examples are debtors and receivables, etc. Now, since we have understood what are assets, let us have an understanding of what are liabilities. Liabilities are obligations which a company owes to others, which have an economic value and can be expressed in terms of a monetary value. Some of the examples of liabilities are a bank loan, a creditor, capital, what a business owes to the owner who has invested his money in the company. Types of liabilities. The first one is a fixed liability. Fixed liabilities are have long-term life and generally payable over a period of more than 1 year. Some of the examples are capital, long-term loan, etc. On the other hand, current liabilities are debts having shorter shelf life and are generally payable or discharged within a span of less than 1 year. Examples are creditors, bills payable, etc. Let us discuss some of the important terms in accounting. The first term is an expense. What is an expense? It is just generally a cost of acquiring some product or service. Some of the common examples of a business expense are like rent, wages, salary of people, depreciation. While the initial part, the rent, wages and salary are the cash expenses, however, depreciation is a non-cash expense. What is an income? So monetary earning through business operations or by offering any service. Example of income are dividend received, sales revenue, and interest received from some bank or some investments. Loss. In accounting term, a higher balance of an expense over income is a loss. So the general words which are used in accounting, examples are gross loss, net loss. Profit. On the other hand, a higher balance of income over an expense is a profit. And examples in accounting used are gross profit and net profit. One of the most commonly used term in accounting are debit and credits. They are simply two important sides or aspect of an account, and they represent the below mentioned. So whenever there is an increase in an asset or an increase in an expense, at the same point of time there is a decrease in a liability or a capital or a revenue, it is always a debit. And vice versa, if there is a decrease in an asset and expense and an increase in a liability, capital or revenue items, it is always a credit. So this is an important thumb rule, what we should always remember. And in future when we would be doing the journal entries, This rule would be too useful for an accountant. We have been hearing a lot about accounting and the various terminologies. Let us come and understand an important aspect of accounting is an account. So what is an account? It is a record or statement of financial transactions expressed in monetary values. Account helps in identifying the monetary balance under a particular head. Types of accounts. There are two types of account. One is the personal account, and personal account is an account of individual or a collective group of individuals. An example of personal account are Ram account, Sham account, etc. Impersonal account. Impersonal account are again of two types. One is the real account, second one is the nominal account. So real account are account dealing with real or material things such as land account, building account, etc. Whereas the nominal account dealing with a particular category such as an expense, loss, earning or profit, etc. Now coming to one of the most important rule of accounting based on which the entire premise of accounting rests upon. And this is just nothing but the 3 golden rules of accounting. And these 3 golden rules of accounting are related to 3 different accounts what we read just now. The golden rule for accounting for personal account is debit the receiver of benefit and credit the giver of benefit. For the real account, what comes in is debit and what goes out is credit. And for the nominal account, all expenses and losses are debit, whereas all income and gains are credit. So this golden rule is one of the most important thing what an accounting beginner should remember, because this becomes the whole and sole premise of understanding and passing a journal entry, which in turns are transferred to ledger accounts. So without an in-depth understanding and relating these accounts with each other and with the accounting concept, passing a correct journal entry becomes difficult. So again repeating, this is one of the most important and utmost tool of accounting and should be understood with a lot of deep care. Thank you and stay tuned. And if you have really found this information relevant, please like and subscribe to our video. Have a good day.